Today we're going to talk about taxes. We got our friends over at Pacific Premier Bank, an expert that's worked in the past with the IRS and has the licenses, certifications to talk about this specific topic, taxes, which I know you love taxes, I love taxes, we all love taxes, right? As a small business, it's important to understand everything you need to know about taxes. This is going to be a great workshop to watch, and be sure to share with your friends, especially if you know anyone that's a small business alike. A very, very important topic about taxes as we get closer to ending the year, closer to paying our taxes, right? So without further ado, pass it on to our friends over at Pacific Premier Bank.
Welcome to tax planning and reporting for small businesses. By taking this training, you're taking an important first step to building a better business. My name is Tuta Aitene. I'm a senior credit analyst at Pacific Premier Bank. I've been working for Pacific Premier Bank 4 years now. I have a master's degree in business administration, and I am IRS certified tax preparer. This training material is intended as a general guidance only, and it's not intended to provide professional advice. After completing this training, I hope you will be able to identify the federal, state, local tax requirements for small business and its owner, and establish a plan to accounting method. As a small business owner, you generally will have the responsibility to pay tax through the year. To know how to pay your taxes, you need information about business accounting, the legal form of your business, and tax requirements. You will need to find out how to establish your tax year, accounting methods, tax preparations, and payment options. Having good accounting system will help you track income and expenses and give you clear information to calculate your taxes and file accurate tax forms. Business owners may pay several types of taxes: income taxes, self-employment tax, employment and unemployment taxes on employees, excise taxes, state, local taxes, and fees. Your income tax is based on a net profit. This is essentially determined by subtracting your business expenses from its income. Business expenses are those that are ordinary and necessary to operate or run the business. Sole proprietorship, partnership, limited liabilities, companies, and S corporations show their net profit on the owner's personal income tax form. C corporations pay corporate income tax. If you are in business for yourself, including a part-time business, or carry on a trade or a business as a sole proprietor or an independent contractor, you are generally considered by the IRS to be a self-employed. You may pay self-employment tax, also known as a Social Security and Medicare taxes, if you are self-employed. You must pay self-employment tax if your earnings are from self-employment from $400 and more. If you have employees, be aware that there are several employment taxes. Some are paid by the employer, some by the employee, and some are shared. Employers withhold federal and state income tax from employees' wages, of course. Employers withhold part of Social Security and Medicare taxes from employees' wages and pay a matching amount. Employers generally pay federal and state unemployment insurance tax. You report and pay separate from other taxes. Employers pay into state disability programs too. Tax identification number. You must have a taxpayer identification number, which is abbreviation TIN, as the IRS can process your return. The two most common types of Social Security numbers and the employer identification number, EIN. An EIN is issued by the IRS to sole proprietors, partnerships, and corporations. Of course, you will need an EIN if you have employees, you have a qualified retirement plan, operate your business as a corporation or partnership, or file returns for the employment taxes. You can apply for EIN number from IRS online or via phone. Federal income tax forms. Your business structure impacts your income tax payment and the forms you use when you file your taxes. For example, partnerships, sole proprietorships, S corporations, and limited liability companies are not taxed separately on a business profit. Instead, the profits pass through the business to their owners, who report business income or losses on their personal tax return. C corporation is the only type of the business that must pay its own income tax on profits. Sole proprietorship. Sole proprietorship is a profit and loss from business. Sole proprietor, Schedule C or Schedule or Form 1040. You list your income and expense of Schedule E or to determine your net profit. Partnership. So I'm sorry, for the sole proprietorship, it's only one person. You cannot have multiple persons, that's why it's sole proprietorship. For the partnership, You can be in partnership for maybe 4 or 5 partners. It depends on the percentage of the shareholders and ownership. A partnership must file their annual information return to report the income, deductions, gains, and losses. The partnership must also furnish copies of Schedule K1 from Form 1065 to partners. Partnership is the relationship between 2 or more people to do or trade business. Each person contributes money, property, labor, or skills and share it in the profit and losses of the business. Partners are not employees. The business must furnish Schedule K1 to all partners from the business tax return, which is the Form 1065. The partnership profits or losses pass through to its partners. Each partner includes his or her share of the partnership income or loss on his personal tax returns. S corporation. S corporation, it's the form, it's 1120S. S corporation allows to pass corporate income, losses, deductions, and credits through to their shareholders for federal tax purposes. Shareholders of the S corporations are issued, of course, Schedule K1 showing the income to the shareholder received through the corporation. Shareholders of the S corporation report the flow through of income and losses of their personal tax returns. Requirements to be an S corporation, you can be a domestic corporation, have only allowable shareholders, not partnerships or corporation or non-residents. And then you can have no more than 100 shareholders. For corporation, a corporation conducts business, realizes net income or loss, pay taxes and distributions, profit to the shareholders. The profit of corporation is taxed to the corporation when it is earned, and then it's taxed to the shareholders when distributed as a dividend. So this is kind of different. Corporations are more bigger corporations. If you want to establish a business as a corporation, you can. This is more for big businesses usually, but for small businesses, they're not corporation, more they are S corporation or partnership, usually by managers. So small businesses rarely I see that are corporation. A limited liability company, which is an LLC company, the federal government does not recognize a limited liability company as a classification for federal tax purposes. An LLC business entity must file a corporation, partnership, or sole proprietorship tax returns. Federal employment taxes. These taxes include tax employers that are required to withhold from their employees' wages and taxes to the employer's pay. You need to manage payroll accurately to compute and collect the appropriate taxes. Then you must pay those taxes to appropriate agencies on a monthly, quarterly, or annual basis. Employment taxes vary depending on the type of the business, location, and other factors. Start by registering a new employer by the IRS and New York State Employment Department. You file this form with, so for the Form 940, you file this form with the IRS annually to report the amount of federal unemployment tax for your employees. Form 941, excuse me. This form is used by employers to report employment taxes, withholding amounts, deposit amount, and amount due to the IRS. Your state will have additional employment tax forms and payment. Some common state employment tax include disability and unemployment. Other forms are W-4, which is completed by an employee to indicate his or her tax situation, exemption, status, etc., to the employer. The W-4 form tells the employer to correct amount of tax withhold from an employee's paycheck. W-2 forms, the form that an employer must send to an employee and the IRS at the end of the year. The W-2 form reports an employee annual wages and the amount of tax withheld from his paycheck. We all see W-2 are mostly full-time employees, part-time employees. You can be a business owner and you can have a W-2 yourself. If you're a manager for LLC, you still can do this. You can pay yourself and then you can still have your shares. Form 1099, miscellaneous. While you will use the W-2 form to report wages you pay to an employee, you generally use the Form 1099 miscellaneous if you pay independent contractor to do work for your business. Generally, if you pay more than $600 during the year to someone other than a corporation and in the course of your trade or business, you must file a Form 1099 miscellaneous. So it tells you how much you pay to the person, because that's going to be recorded. To report payments on a Form 1099 miscellaneous, you must obtain the person's tax identification number, which is a TIN, is often their social security number. So there are just rare people that don't have social security number. They can have the taxpayer identification number for if they don't have social. If they don't have social, they mean they are in process of the legal documents. They can still have a taxpayer identification number so they can file their taxes as well and receive income. And yeah, this way IRS is going to record their income. State and local taxes. In addition to the business taxes required by the federal government, you're likely to pay state and local taxes. Each state and local has their own tax laws. In California, of course, we do have state and local taxes and other taxes. Most states collect state income taxes from individual and businesses. Permits. Local jurisdictions can require special permits depending on the type and location of your business. License are often require business to purchase business license. Of course, to have a business in California, you have to have your license. You have to establish your company. You have to file a form for statement of information, article of incorporation or operating business agreement, and such thing. So once you establish your business, you have to establish your business to the California, let's say, and it's going to be through the state. There is a website that we always verify the companies. It's a public access. We cannot retrieve a lot of data from there, but just like a business, if it's active, it's a business in they report if the business doesn't pay taxes, if they're due on tax returns. There are companies that if they don't pay tax returns, so their license is taken, so the state terminates the license and doesn't let them do the business in California. So you have to be careful to file the form as well as pay your taxes because that's going to be reportable to state. I cannot pronounce it, fictitious business name permit, also called a DBA. A fictitious name is a business name that is different from your personal name. It is the way the community knows that you are running a business under an assumed name. So if you have, let's say you're going to change, you establish your business with a certain name, and you want to change that business name. In order to do so, there is a form, the fictitious business name permit, that you just fill it out and send it over to the state, and it's going to be a DBA. So let's say that the old name is going to be there, then DBA used to do business as such and such company. So in case you want to change your business name, you can still use the DBA, which a lot of companies use for their purposes. I don't know why they use two names, but they want to use two names because they can do business in different states with different names. But it's still legal if you have this form, DBA, filed. State sales taxes. If you sell retail products, must state require you to collect sales tax from your customers for the state. Sales tax is governed by state law. So yeah, we have to check that with the state. We also pay, I believe in Orange County, it's 7.75% of the sales price. So when we purchase something, we will see in the receipt sales price. So this is the state sales tax. As an employee, have some of their earnings, each paycheck withheld to pay taxes. Business owners might need to pay taxes to IRS on profits as they are earned through the year. These estimated taxes are made during the year and are used to pay income tax and self-employment tax. If you do not pay enough, you may be charged a penalty. Quarterly estimated payments. If you are filing as a sole proprietor, partnership, a corporation shareholder, and or a self-employed individual, you generally have to make estimated tax payments through the year. If you expect to owe tax of $1,000 or more when you file your tax returns. A corporation that expects to owe tax of $500 or more when filing its tax return must make estimated tax payment. Use IRS Form 1040-ES to calculate your estimated tax. Again, there's Form 1040-ES at the IRS to calculate your estimated taxes. Typically, business owners pay estimated taxes to the United States Treasury quarterly based on profit to date. Federal income tax and self-employment tax are paid quarterly in a combined payment by April 15, June 15, September 15, and January 15. Most states require quarterly estimated income tax payments as well. The calculation of your tax will depend on your tax year. This is generally the calendar year, but could also be a fiscal year, only 12-month period that ends on the last day of the month except December. So let's say there are a lot of companies that they've established their year, so it could be their yearly the yearly fiscal year can be in the middle of the year. So let's say June 2021 to May 31st, 2022. So you can choose your date, but it has to be that 12-month period. So it will count for 12 months. So money management of taxes. It's important to establish a system for managing your money for tax obligation. Taxes are generally due monthly, quarterly, and you need to have the money in the bank when it's time to pay. Business owners sometimes make the mistake of spending their tax money on business operations. And when the taxes came due, they are short of funds. First, as mentioned earlier, find out that what taxes you will owe, when they are due, and estimated amount. There are several types of taxes you could be responsible for, including income, sales, and employer taxes, and each are filed with different agencies at different time. For income taxes, you'll need to set aside a percentage of your net profit to pay quarterly estimated tax. If you are a retailer, you need to set aside the sales tax you collect on each sale as you can pay it to the state sales tax agency. For employer and employment taxes, you need to set aside your portion of Social Security taxes and the taxes you have withheld from your employee's paycheck. You can use separate bank accounts to set aside tax funds, or you can use your business accounting software to keep track of the funds so you know how much is available to operate and what is off limit, because it is the reserve you need to pay your taxes. Accounting system. To reduce tax profits, you can deduct many business expenses such as rent, utilities, inventory, advertising, website development, to name a few. To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your field of business, trade, or profession. A necessary expense is one that is helpful and appropriate for your business, trade, or profession. An expense does not have to be indivisible to be considered necessary. Check with IRS website or an accounting to learn what you can deduct from your sales to determine taxable net profit. There are a lot of taxes different businesses have, like they say here, like I said earlier, rent, advertising, employees' wages and salaries, or officers' compensation. There are a lot of depreciation you can put there to deduct your expenses. More expenses is better because how it's calculated in the tax return is that you have your sales, you have your expenses, and then it's net profit. So in the end, that's how you pay taxes based on how you have the net profit. And then in the tax return as well, you have to actually have the distributions to see how much you pay to your shareholders or owners. There are also, if the owners contributed on your business, it's going to be still recorded under the tax return. You should have a good bookkeeping system to track all this income and expense. Your booking system should consist of tools to document the business, sales, and expenses. You can use a business accounting software program to help you track and organize income and expense. But if you don't want to have any software, you can still have your Excel. If you're good in Excel, you can create a table there. You can create formula, and you can calculate your expenses by yourself. You don't need to spend money in a lot of system software if you don't want to spend. If your business is too small, you can still manage it by yourself. With some help, with accounting or the IRS website, you can create your company file with this software. The software will organize all your income and expenses according to the accepted business accounting principles. If it can generate reports to calculate your net profit, as I said earlier, the basis of calculating your tax obligations. Your business accounting software can also help you know what sales taxes you owe. If you use a payroll service, it should give you reports you need to file and pay for your employment. Two reports that are particularly useful are the profit and loss statement. This shown the income, so there are two particular reports. So again, profit and loss statement and balance sheet. Okay, so on profit and loss, it shows the income and expenses of your business for a given period of the time. Usually companies have to have a profit and loss statement and a business balance sheet quarterly. So you have to record quarterly these financials so it can give you a good picture for the full year. In the profit and loss statement, you show the income and expenses of the business versus in balance sheet, you show your assets, liabilities, and your equity in the business on a given date. It's important to keep all the documents that support the entire in your books and on your tax return. Keep them in orderly fashion and in a safe place. For instance, organize them by a year and type of income or expense. You must keep your business records available at the time for inspection by the IRS. Keep good records, receipts, statements, checks, invoices, and register tape will help you know your net profit and your associated taxes. If the IRS examines any of your tax returns, you may be also asked to explain the items reported. So they can call you for, they can say you have to come because we find something, we all get audited from IRS. So if the IRS call us to show up at their office because they need an explanation from you to see what you did in your tax returns, perhaps it's filed in error, so you have to have a backup in order for them to see it and make that correction. So if you have all of this with you, don't worry about it. If you have all the records and you're showing it to IRS, it's going to be fine because not very many companies are organized, let's say, and have these with them, and that's caused a problem. Because if you file something incorrectly, then IRS is going to give you a penalty, and that you don't want that penalty because it's going to be a lot. So in order to avoid that, you just keep this, be organized, have this with you, and when time comes, let's say after a year or 2 years, you still have it with you, and you can show up at the office without being, having that fear of what's going to happen, how they're going to, tell me to pay more taxes and stuff like that. Also, there are two basic accounting methods, so cash and accrual. So when you decide which one you want to choose, the tax returns, filing your tax return is going to ask you in the box on the top of the tax return, you can check the box, it says cash or accrual method, because that will affect the calculation of net profit. These methods are different in the timing when transactions, including sales and purchases, are processed by your software program. So the cash method is more commonly used method for small businesses. Under the cash method, income is not continued until cash or a check is actually received, and expenses are not counted until they are actually paid. So let's say cash method, you have that income, you just sold something, you have that income in your hand, and then you're gonna want it to record that income right away. So you don't wait for, there are a lot of companies that choose this method. It's very easy, it's simple. When you record something, when you sell something, so when you have your money to your hand, you record that. Versus the other method, the accrual method is income is continued when the sale occurs, and expenses are continued when you incur them. You don't have to wait until you receive the money or actually pay money out of your checking account to record a transaction. So if you do accrual method, you can record once you sell something, but they didn't pay you yet. And then you issue an invoice. When you issue an invoice, you didn't receive that money, you record that anyway. So these are the difference between cash method and accrual. And these are very important because a lot of big companies use accrual methods because they cannot track what's the money in, when it's coming. They cannot track when they sold something to not forget to issue the invoice. But usually for small businesses, very easy method, cash method. It's very easy if I recommend you to do cash method if you have a small business. So you can record that easy on you, and you can, it's going to be very, very simple method. Using an accountant is important. You can get help from the Internal Revenue website, so IRS, the Small Business Administration website, or a tax advisor, such an accountant or enroll agent. You don't have an accounting to manage. If you don't have you don't have to have an account manager. You can manage it by yourself. Many people can think they can do it themselves, but if you have a small business, you don't really need an accounting. But if you are a little bit than a small business, of course, you'll need an accounting so they can track your taxes, your expenses, and income. The IRS provides complete information on its publications for you to learn how to manage business taxes yourself. You can fill a form by hand, or you can purchase a tax software, like I said earlier, programs where you import your business bookkeeping software data. It is important, however, to know what services a qualified account provides. You need to assess your skills and time to learn how to file your taxes. You should also consider whether it supports your business management and growth to spend your time on a tax management and filing. Some small business make do with a bookkeeper, someone to perform the task of reporting financial information, creating financial statements, and filing taxes. But good small businesses accounts do much more than recorded transaction and generate documents. They actively analyze and interpret information to help you run your business better. An accountant can give you an advice that's a professional advice. They can tell you what you're doing wrong with your company, because a lot of companies, they have a lot of sales, but then they cannot track their expenses. So when you have a lot of sales, but you're not tracking your expenses, the business is not going to make a profit. It's going to make a loss. A lot of companies struggle with this because they don't know how to manage the cash on hand. So that's expenses. They want to do, let's say they have too many sales, and then they have a lot of expenses, because now once they have sales, they have to produce, and then they need more material, and then that's how it raises the expenses. But if you know how to manage your expenses and you're saving that, you're receiving a lot of sales, that income, it's good to manage expenses and income. So maybe accounting can give you a professional advice. I can't, but this is just for the presentation. But it's good to consult an accounting before you decide how to proceed with your taxes. Services business accounts offer. In addition to tax preparation, qualified small business accountants are able to help with the business counseling, consulting, personal finance advice, legal formation, financing, audits, and review or audited financial statements. Some accounts have many years experience working with the business owners. They can provide insights, examples, and information to help you grow your business. Personal finance advice. An accountant can help you understand how to set up a retirement plan, plan for a home purchase, or navigate a change in your personal circumstances. Legal formation. As discussed earlier, there are several legal structures for the business. An accountant can provide information on the options available in your state. Your accountant can also refer you to an attorney who can provide you customized advice and assistance in business information. Financing. If you need a loan to grow your business, an experience in accounting can help you determine what type of financing is appropriate, what you can afford, deal structure and advice, and referrals to loan sources. So let's say you need a loan because you have a lot of sales, and then you see your expenses are growing, and now you need more cash. So you go and take a loan to the bank. When you take that loan to the bank, you can actually put that on your expense. Now you have a loan. So it's going to help your tax, your financials. So that's how a lot of loans are, a lot of companies use a lot of loans because they can expense it. Although there is an interest rate on it, you can still, that interest still is going to deduct from your taxes, so it's recordable. Audits. You should your business get audited, your account can help provide information and explanation to the auditor. Usually auditors, we have in the bank, there are a lot of auditors that they come every quarter. So they come and audit our bank to see, are we recording everything correctly? They check the system, they check everything. So, and then we have to balance with them. If we don't balance with audits, they're going to report to IRS that's saying, hey, this business is not doing well with financials. They're reporting things that are not true. So audit is very important. You can do it yourself. If you have a small business audit, you can just do it perfectly fine by yourself. Of course, you will need legal advice as well. But yeah, it's good to audit your business. Reviewed or audited financial statements. Most small businesses won't ever need a reviewed or audited financial, but occasionally for outside investment or incorporation, a business owner might need reviewed or audited financial statements. Only certified public accounting are qualified for the service. It says CPA audit when the financials are recorded. So there are key points to remember. Taxes can seem complicated to a new business owner, which is fine, but you can do it. Invest time in learning, ask questions, get qualified advice. This all will help you. So it will become part of your routine as a business owner to find out the amount and process of your federal and state income tax, self-employment tax, employment tax, sales tax, local taxes. So these are 5 key points to remember. Also, never borrow the tax funds for daily operations. Create a plan for setting your tax money aside as you can pay on time and avoid penalties. I have some question for you here. If anyone have a question, I'll be able to answer. You feel free. I can provide my email address if needed, and then I can try to help with your questions. So we learned so far I hope you learned managing your tax obligations, typical tax of business, pay income, self-employment, sales, employment, and local taxes, the form and the process used to pay business taxes. This is all for today. There's a pre-post test at the end. If you want to try your knowledge, I can share it with you and you can send it back to me. And I hope everything that I went through today helped you establish your business.
First question that I have for you is since in conversation that I had with you is you underwrite a lot of loans, you oversee a lot of all these applications. What are some of the most common mistakes or things that if you have a business or you're gonna have a business, people should avoid? Maybe let's say the top 2 or 3 that you've seen.
On financials, usually I do detective work. So we have a system that we take that data in. The system is going to calculate everything for us. However, we have sometimes some numbers that are off the chart. So let's say they have a line of credit or overdraft, right? So they never reported before, but all of a sudden they had like $300,000. That's a red flag. So we always go back and say, hey, what is wrong with this number? What can you explain? So they try to explain, it doesn't make any sense. And then we say, but can we ask your accounting? They say, sure. So when we go to accounting, sometimes they report something just because of the tax purposes, okay? So sometimes it might not be how it is, but the accounting may change it. So there are some numbers that sometimes doesn't make sense, but they are just for tax purposes, okay? So that's the one that I've seen so far. There are, a lot of things that pop up sometimes, and it's very difficult to deal with, but mostly it's for tax purposes. Everything the company they do it what the accounting is telling them. So it's for the good of them. If they file something, it's going to help their tax returns, because a lot of companies honestly have a lot of sales and that not necessarily has a net profit. So in order to avoid some of the mistakes that can make them more profit, they report something else in just because of the tax purposes. So that's the only one thing I've seen. We look very closely to the details and numbers where they go with, because we have like every year quarterly financials, so we have to compare. And then so if we see different numbers somewhere different, or wages, like perhaps PPP loans. Do you know about the PPP loans? Yeah, so they have PPP loans and they have the business, but when we take out the PPP loan, actually they don't make net profit, so they help the business stay in business. But there are a lot of interesting, due to COVID, it's just interesting to see financials, and it just it's like puzzle. You put all pieces together, and it just sometimes it's for tax purposes. It's not intent to have that in their tax returns, but yeah, sometimes they do things like that.
Okay, that's good to know. Very good to know, especially if you're watching. It feels like it's always best to hire someone that knows what they're doing, so that way they can help you.
Yes.
And
a lot of companies, accounting companies, help businesses.
Last question. Speaking about taxes, a lot of businesses that we work with, maybe they just started, they haven't paid taxes, they don't want to pay taxes. Why should companies, whether they're small or big, pay taxes? Because there's a lot of businesses that say, no, I don't want to pay taxes. I want all the money to myself, only cash and whatever. Why should they pay taxes? Why do they have to pay taxes?
Because it's a law. And unfortunately, our famous state, California, has a lot of taxes. We pay more taxes than other states. But if the company is established as a company, that means that they have their business certificate, they have a business license, they have everything established, but they're not reporting income. However, if they're not reporting that income, means that it's cash, right? Mm. So cash is not tracked. Nobody can track cash because they don't know. Unless they have something via bank, which is recorded, that's something else. But if it's cash on hand, you don't have to record, of course. Why would you? But if you have your business established and you're not making profit, you can still file for loss if you have something that your company, you don't want to report, your income from the sales, but you want to record your expenses, that's going to give you a loss. And that loss, you can still file it. You don't owe taxes, but because you have loss. So it's a lot of different people that do different things. But once you have recorded, like let's say you have an income that is recorded, you must file taxes because IRS, believe me, tracks everything. So everything that is recorded, you got to be careful. You report that income or you're going to be in trouble. It doesn't mean that you're going to be in trouble right away, first year, second year, or third year, but they're going to come after you somehow. So, I will not take that risk because the fines and penalties are really high. You don't want to go there because they're going to, sometimes when you have too much going on with IRS and you are reported as not doing the business correctly, they can take the license from you and you can never do business in California. You have to go out of the state to do business. You know what I mean? Mm-hmm. So in order to avoid that, you just have to be careful. Whatever is tracked, banks, transfers, anything in paper that is, invoice, whatever, if it's recorded, be careful. I would recommend that because I work for IRS too, and it's just, things that we've seen there, it's different because they go off the really, really detailed, and they have a lot of auditors that look for these details and the trigger. They find one, they want to find another one and another one.
Mm-hmm. Yeah, and I saw that the IRS is hiring like something like over 80,000 new employees. So they're definitely going to be tracking.
Yeah.
And you mentioned that as soon as you, go ahead.
No, go ahead.
I was gonna say, you mentioned as soon as you make $400, you already hit with the self-employment tax, right?
Yeah.
Wow.
Target for IRS, IRS audit us as a personal. Like if we file our personal tax returns, they're going to audit us every 2 years. But mostly they go off the self-employed people. Why? Because self-employed people, they make mistake by reporting a lot of expense. So if they're reporting a lot of expense, not income, sometimes you cannot deduct a lot of expenses as a self-employed. There is a sheet in IRS that tells you which expense you can file, which not. Because a lot of people put a lot of expense there, but then when they got audited, they got shocked. Oh my God, what I do? Because they didn't read what's the requirements for the expenses. And usually IRS is after them. I know people that have been audited from IRS 8 years, 10 years. And that's like, let's say we were in 2015. No, I'm sorry. We were in 2016 and then he got audited from 2008 to 15, so 10 years. Wow. He got in trouble. He was self-employed. He filed a lot of expenses. Oh yeah, for the 10 years, he was receiving money from IRS and make profit off IRS, but then he got in trouble. And guess what? IRS filed a lien against him, $85,000. Yeah, this is a true story. I've seen it with my eyes.
So if you're watching, pay your taxes. Pay your taxes.
Yeah, it's bad.
Yeah, wow, that's crazy. Don't over exaggerate your expenses, Yeah.
Yeah, I just they go after self-employment. So when they see Schedule C employment, business owner that is self-employed, let's say, or they work for companies like Uber or these drivers for
Uber,
delivering
Lyft,
the food. These are all these are all self-employed. So they're looking for them. They see what they put there. Are they making money? Are they reporting stuff good or not? So they watch for them. So if you're self-employed, be careful.
Thank you so much. And thank you for the audience, everyone that attended, everyone that's part of this, great workshop and more to come. Thank you, everyone. Have a great rest of your day, everyone. This workshop was filled with a lot of great insights. I don't know about you, but I learned a lot of things that, I'll be taking back. I'll be sharing with people as well. But it's really important as you're watching the workshop, if you want to go back, take notes, Do the very best so you can retain as much information as possible, because taxes is an important topic that a lot of small business owners, fail to pay attention to, or they're just paying their CPAs and accountants and they don't know what's going on. They're just paying this person to do their taxes, and it's good to have somewhat an idea of what's going on, why they're doing your taxes this way, why is it an LLC or a sole proprietor, whatever it is, right? You need to know what's going on with your business. That you need to know, you're the owner, right? You want to know how it's going on. So very important, we understand taxes and we can apply it and share with your friends and family. This workshop should be not just for you, so you could benefit other people in your community, your friends, your family, maybe someone that wants to start a business and wants to get an idea of what they'll have to deal with when it comes to taxes, because we all have to pay taxes. We can't escape it. Whether you're a business or you're working for someone, we all have to pay taxes. If you like these workshops, check us out on YouTube. You can subscribe to us. We have a lot of, we have weekly podcasts where we talk about a lot of different topics, a lot of different, topics we're talking about there. Check us out on YouTube, on TikTok, on Instagram. And without further ado, thank you and have a great rest of your day.